as China has now started to reopening, and what do you think that will mean to the economy and also to the market?
Thank you for the question, Enoch, and thank you for having us. In fact, we think that the reopening is completely consistent with our expectation. We were one of the few contrarian view holders who believes that China will probably reopen soon after the completion of the 20th CPC and before the end of the year. I think what we are seeing in the economic front is that with that reopening, it allowed people to go back to work, go back to school, and resume their work. Day-to-day economic activities get to come back. However, in the near future, we think, for example, as we speak, or going into even first quarter of 2023, we probably will see some confusion as people wouldn't know when to go out, when to stay home, and whether it's still safe to go out or not. So even if that there is no more zero COVID policy constraints that prevent them from heading out, the problem is that people may not have the confidence to do so until they are reassured that actually infection cases have already peaked out, and in fact they can be totally sure about the herd immunity being completed. And then they will head out, which means in the first quarter of 2023, we'll see growth tanking quite significantly. But then by second quarter, sequential wise, it will come back quite notably as well. And we're expecting growth to rebound from negative numbers from first quarter to second quarter 5%, and then above 7% in the third quarter. So from third quarter onwards, it will be full swing back.
And how about in terms of the stock market?
Yeah, sure. Market usually lead the fundamental. So if the recovery of the fundamental economy is starting from second quarter, market pretty much need to position for the recovery now, right? And in October, at the worst, the market really pricing a lot of risks. People worry that China may not reopen anytime soon. People worry about geopolitical tensions. People worry about property-related hard landing. And in the past months, we saw the supportive policies on zero COVID, relaxing the zero COVID policies. We saw more support on property, right? So, for the market, it also rebounded 20% from the low. So many investors ask, what should we do now? Should we sell into the rally or do we buy more on the dips? Our view is that it's still a good opportunity to buy on the dips in the next few months, because currently in the market, there's still a lot of doubts about the path toward reopening, about the certainty about economic recovery next year. And that means, the multiple is still not reflecting a consensus bull case yet. Right? Currently, the PE valuation of MSCI China is only 10 times. It's back from 8 times at the low, but compared to long-term average PE multiple of 12 to 13 times, there's still 20 to 30% room for multiple expansion in the next few months. So we still think that next few months, as we see more confirmation of China moving toward reopening, confidence start to come back, economic activities gradually moving toward reopening, market will further enjoy the multiple expansion.
Well, in terms of the sector, if China really completes this reopening process, which sector are likely to be the winners, and will there be any losers?
In terms of the winners, generally we recommended the two baskets, right? One is the reopening by direct beneficiaries, typically in the consumer-related names, hotels, beers. Second is transportation, airline, airports. Third is Macau gaming, hotel-related names. And finally is some of the internet e-commerce-related names. But also another important basket to consider are those large-cap, index-heavy, liquid, high-beta names, because many investors have been underweight in China, and with the China market re-rating, they will be under pressure to catch up and reduce their underweight. So the large cap liquid high beta names will be key beneficiaries to lead the multiple expansion. In terms of the loser side, this year, generally value stocks outperform the growth, because when people have no confidence on growth, you fall back to value. So, banks, for example, energy names, they were big outperformers this year. But next year, or in the next couple of quarters, as the risk on trade continue, we might see more rotation out of value going to growth.
We have seen the stock market in China and also Hong Kong has been bounced back in November. So is it time to sell, or actually you think maybe the market can continue to go up, and is actually a good time to buy China stock?
I do think it's a good time to buy China stocks because going forward, we can see potential upside for both multiple expansion and earnings growth, right? In terms of the multiple expansion, multiple of MSCI China currently is 10 times, right? I don't expect them to go back to last year's high of like 16 to 18 times, but just going back to the normal level over the past 15-year average, that's 12 to 13 times. So 20 to 30% potential upside from multiple expansion, but also in terms of the earning growth, as economic activities recover, corporate earnings will recover together with the macro economy. And next year, we should see double-digit corporate earnings growth. So there's the earnings angle of this rally as well.
Let's turn the focus to Hong Kong. We have scrapped this hotel quarantine rule in September, but we still have this so-called 0+3 requirement that actually visitors still need to have tax in the first few days, and in the first 3 days they can't go to restaurant or the pubs. What does that mean to Hong Kong economy? You think Hong Kong should go further from this 0+3 rule?
Yes, we certainly do. We think that the 0+3 probably will just remain notionally, in place for some time. However, what goes in there, what's the content that is required for the international arrivals to do will probably be changing over time. In fact, as we speak, we think it has already been calibrated. So after the first PCR done at the airport, in fact, the international arrivals are now only required to do one more PCR test 2 days later instead of another 3. So we think that such adjustment would continue to go, as we see that Hong Kong push forward to attract more international visitors. And we think that as China also, potentially borrowing a page from the playbook that Hong Kong has been using since spring this year, that probably implies that there is more hope also for, opening up the border with mainland China. And when that becomes more feasible, this 0+3 probably no longer has to remain in place. By then, we will have officially 0+0.
Mm-hmm. We are now going to go to the end of the 2022. And so for the new year 2023, what do you think to be the major challenge of Hong Kong and China in terms of macroeconomy and also the market?
From the macro perspective, we think that for China, the most important thing to watch out for is the path for reopening. So COVID policy adjustment, in our view, is more important than fiscal, monetary, or even property policies at the moment, because that is the most important constraint at the moment on the overall economy. However, going forward, we think that once that we see a more stable path on the reopening front, we probably will see the investors turning more concerned about the potential outlook on the property market, and also on for example how private businesses can be handled, and whether policies would actually turn more business friendly, etc. So those, I think, would be the ones that China need to watch out for, especially in the environment where we're forecasting as a house. Bank of America is forecasting recession being very likely in the US, Europe, and also, to a large extent, some of the other DM economies. And if that's the case, the weaker external demand is also going to be an important threat for China's recovery. For Hong Kong, the most important thing to watch out for is for China reopening as well. We are expecting a big rebound from a -3%, GDP growth from this year all the way to +3%. So it's going to be a huge swing. Of course, that's going to be most importantly hinged on the fact that China could manage this reopening well, and China and China and Hong Kong can reintegrate really well as a bigger economy. Thank you.
From market perspective, this year investors' top 3 concern on China market were reopening, property market and hard landing, and number 3 is geopolitical tensions. I'm very glad to see the progress on the reopening front, but in terms of the property market and financial systemic risks, we still need the home buyer confidence to come back to really support the property transactions, the real financial cash flow of many of the private developers. And also, as economy recovers, interest rate liquidity next year is likely to be tightened. So there could be some delayed pressure on banks' asset quality. That's also something to watch out for. In terms of geopolitical tensions, the initial trade war has extended into the financial area, the technology area. So one thing investors have been waiting is the auditing result for PCAOB's inspection in Hong Kong. Hopefully we'll get some clarity within the next month or so. And for next year, there could be further risks in terms of the technology-related sanctions, trade bans, and escalation of geopolitical tensions could potentially derail the market as well.
I would also like to ask about the internationalization of RMB, because the country really pushed that process, but we have seen that the RMB actually depreciate quite a lot against the US dollar. Under that situation, will that affect the plan of the internationalization of the currency?
Well, we think that the currency value is certainly important to watch. However, we think it is understandable that the yuan has depreciated notably against the dollar in a year when the PBOC and the Fed has their monetary policy stance diverging quite substantially. So did the central banks from many of the emerging market economies. In fact, even in DM economies, look at the yen, the pound, and also the euro. They have depreciated against the dollar as much, if not more. And therefore, we don't necessarily think that the temporary, fluctuations in the FX will be the most important driver for internationalization of the currency. But that said, we think that more importantly, we should be watching, for example, the usage of of RMB in international trade, as well as the liberalization of capital account. And after the COVID relaxation, we think that on both fronts, we probably are going to see more, important initiatives coming out.